helping to facilitate the session here today. Of course, I do want to introduce the chair of our education, employment, and entrepreneurship working group for the Road to Economic Prosperity. So please, thank you and welcome Jerisa Jones.
So good evening, everyone, and welcome to one of our first presentations on the fundamentals of wealth management, life insurance, and estate planning. My name is Jerisa Jones, and I am from the community of Upper Hammonds Plains. I am the co-chair of the Education, Employment, and Entrepreneurship Subcommittee with REPAC, and Terry Dixon, who is here today, is our chair. It is a pleasure today to introduce you to our key speakers, Frederick Perry and Howard C. Williams, Jr. Fred Perry is a senior financial advisor with Central Financial Group. He is a passionate advisor with decades of experience helping his clients maximize their financial outcomes. Fred is a firm believer that the first principle of safe investing is education and ensures to keep his clients up to date on the market trends and how they impact their portfolio. Our second key speaker is Howard. Howard is a life insurance broker with Qualified Financial Services. His focus is helping clients take the right step to get their personal and business financial affairs in order. He achieves this by working with them to develop and implement a personalized financial strategy that capitalizes on their current situation while ensuring long-term stability and success. As African Nova Scotian people, it is important to plan for our future, especially for our families who we care a lot about. We can achieve this by putting in place a plan for our financial future that provides a level of security that should happen. I can assure you that you will find this information useful in providing you with the necessary tools for financial success. Thank you for signing up for this opportunity to learn about wealth management, and I hope you enjoy this presentation.
Okay, my name is Fred Perry, as you're quite aware of. I'm a senior financial advisor. I've been in the industry over 46 years. And the reason why I wanted to take on this task is to educate our community on the importance of wealth management as it deals with life insurance and estate planning. My partner, Howard.
Hello, my name is Howard Williams, and I'm very happy to be here tonight. I think it's so worthwhile that we get an opportunity to share some of the information that a lot of people want to know about wealth management, including insurance and investments. So Fred and I both are very happy to share some of our wealth of information that we have gathered over the many years. I've been in this industry now for 41 years, and I enjoy it very much. Hopefully tonight we can share some things with you that will help enhance your financial life. Thank you.
Okay, the key questions that most people ask today in today's world, one of the things is why life insurance? Another question that comes up, why I need life insurance? What are the three types of life insurance? What are the riders? What is cash value and dividends as it exists in these policies? What is a beneficiary, primary, a contingent beneficiary? When I die, what do I need to collect the proceeds? Okay, how will it work? And what positive benefits it will bring to my family or to my business? Very, very important. So we're going to dive into this tonight. And let's talk about why life insurance. It's a financial safety net that will provide for your family members, God forbid, if something happens in your family. This financial vehicle will provide benefits to my family, whether living or dead. Life insurance will pay the funeral costs. And a lot of people out there go and buy these funeral plans. And if you don't pay the full funeral plan, most of the time with these funeral companies, it has to be paid in full in order for you to get the benefit. You pay one life insurance premium and something happens in the family like a premature death. The beautiful thing is that we will still pay. So let's say if you had $250,000 and you died and you only paid one premium, your family's going to get $250,000, 100% tax-free under the current tax legislation that exists today. The living benefit, also insurance policy, can supplement my retirement and become a forced savings plan to my family members. And here's one of the vital things that a lot of advisors don't talk about is dependency income for my children. What about if I die at a young age and I have young children that still need to go to hockey, still need to play basketball, baseball, all the necessary sports, and also possibly even go to camping events? That money would be there through the dependency income in your policy. How does life insurance work? You have the great opportunity to sit down with a financial and insurance advisor, and his or her job is to ask questions to see if there's a need for life insurance. So what is the life insurance or the financial advisor or the financial planner does? They complete what they call a discovery. A discovery is gathering facts. Where you work, where you live, how old you are, how many family members, all that has to come. Then what the financial advisor will do, he will take that back to his camp and create what we call a financial need analysis. That financial need analysis is a scientific method to come up with the correct amount of life insurance that would be needed in your household or in your family. Then he or she, which is the financial advisor, to come up with an actual need, and it has to be agreeable between you and the advisor as a solution to your financial problems. The key, as long as you budget for life insurance properly, one of the key factors here that you have to realize in dealing with the life insurance is that life insurance can be very expensive. It can be less expensive. The advisor completes, this is how does it work. The advisor completes a paper or electronic application to see if you qualify. You and the advisor agree to the solution, whether it's term, whole life, or universal life. You pay for your first premiums by check, credit card, or even pre-authorized debit. Then the advisor either mails the application to the insurance company or sends an electronic application to the insurance company. Once the application is in home office, there's a team of people that will look, whether it be underwriters, that will actually look and say, hey, this person is an insurable person, we're going to insure them. They complete this process. Once the above is completed, the insurance is approved, either by paper copy or electronic copy will be sent to the insured. Then the advisor will set up an appointment to explain his or her policy to them. Now let's just talk about why I need life insurance. Life insurance can take care of these needs, whether living or dead. Pay funeral expenses. It can replace the income in the household, dependency income. It can pay off any estate costs like capital gains, taxes, lawyer fees, accounting fees, bank fees. It can provide a forced savings plan as a supplement to your retirement income. It can provide for vacations, children's education. It could be a down payment on a mortgage or a down payment on a new car. That's the unique factors that you have with life insurance. Term life insurance, you have 5-year term, 10-year term, 15, 20, 25, 35, and to age 100. What it means is that your premiums are level for 5 years, your premiums are level for 10 years, 20 years, 25 years, 30, 35, and if you take the term to 100, the premiums are level all the way to age 100. But here's the factor. If I have a 5-year plan, I go into it, yes, the cost is very expensive, but after 5 years, I'm 5 years older, your premium's going to be bumped up the second wave. When we talk about the second wave, that means if you re-up that policy again for the next 5 years. And if you have a 20-year plan, you're 20 years older, it can be quite expensive. Whole life insurance, par or non-par. A par company is basically with a mutual company. A mutual company means that the policyholders within that particular outfit at that time have ownership within the company. So let's say, for instance, that the company had a pretty good year financially. Well, then there's dividends kicked out in that particular policy, and a dividend is nothing but an overpayment of premium. But also, what else is a dividend? A dividend is the lapse mortality within the company, the expenses that exist within the company, and the life insurance company's investment portfolio. Universal Life, when it came about, around the late 70s, early 80s, when that came about, that was to combat the idea of talking about buy term and invest the difference. And Universal Life has stocks in it. It has bonds and equities. It has guaranteed accounts like a GIC in that account, which is very unique. These final solutions are based on cost and how much you can afford to cover yours and your family life insurance policy. What are the riders in a life insurance policy? You have term 10, term 20 rider, waiver premium. I will explain those in a quick. Accidental death, non-forfeiture values, automatic premium loan, child term rider, and spouse rider. You want to talk about waiver premium?
Sure. The waiver of premium is a very unique benefit. And the way it works is this way. If you have that benefit on your policy, if you become sick or injured, the insurance company will take care of covering your premiums for you. However, you should be aware of the fact that this cuts in at the conclusion of 6 months. So therefore, you will be required to keep up the premiums for 6 months after the illness or the injury. But once that time has elapsed, the insurance company not only will reimburse you the premiums for those 6 months, but they will take over paying your premiums until such time that you are healthy again or your injury is all taken care of. Another thing that can happen is that they can also use the monies out of your cash value to cover the premiums until such time that you're ready to resume premiums because of your health or injury. Either way, once you have that benefit on your policy, that benefit will cut in and you will not have to worry about losing the protection of your insurance. Another benefit that's on the policy is accidental death. And this is another rider, excuse me, another rider that can be attached to a policy. And if that rider is on the insurance policy, if the person lost their life, unfortunately, by an accident, the insurance company would pay whatever amount of insurance was under that benefit, in addition to paying the regular amount of coverage on that policy. The automatic premium loan is a benefit that, as I already mentioned, would cover the premiums at such time that if the client, for instance, was having difficulty with premiums, the insurance company can always go and take the money out of the cash value in the policy. However, that will create a loan against your policy, which you would eventually have to repay. The other benefit that's on the policy is child term riders. And these are very, very unique. With a child term rider on the policy, the one premium that you would pay, which is very small, would cover as many children in that family for the same amount of coverage. For instance, if it was a $10,000 amount, that same premium would cover the $10,000. And as I mentioned, each child would have that coverage on them. The beauty about this nice little rider is it covers all the children up to age 18 years of age. And if that child or any of those children decide to go on to secondary education, it will cover them up to age 25. Over and above that, before that rider expires, if either one of those children wanted to purchase insurance from that rider, they're guaranteed in most cases to be able to purchase 10 times the amount of that coverage of that rider. So for instance, if it was a $10,000 rider, they would be able to buy a $100,000 policy. The beauty about it is that they would be guaranteed to purchase that insurance without worrying about insurability. It's guaranteed that they could buy that coverage, which is really neat. There's also a spouse rider on the policy. And this is rather unique because especially a family that's just starting out and they're trying to save money. For instance, the husband or the wife could have the main policy and have a rider on, which is really term insurance connected to the base policy. And this would give that spouse insurance in the event that something happened to them as well. It also helps to keep the premium lower until such time that they would be in a better position to afford more premiums.
Non-forfeiture value items, extended term insurance and paid up insurance. Let's say if a person got into difficulty and they've been in the policy, let's say anywhere from 3 years on, there would be cash value in that policy to extend the term coverage of the amount that's being covered in that policy. Now, the paid up additions like Gold Billion. Basically, what you do is you say, take my cash value, and they will give you a paid up policy for what's agreed upon in that particular policy at that particular time. Keeping this simple for you, okay? What is cash value in dividends? I know that a lot of people today talk about cash value is this and cash value is that, but I'm just going to make it simple for you. Cash value is the amount of premiums minus the fees will be the cash value. Cash value can be used to pay policy premiums. You can take out loans at a lower rate than sometimes the banks offer, but the banks now are starting to bump up now, as you can see. You can create asset portfolio that maintains and accumulate wealth. It supplements retirement income, which is unique because every time you look up when you retire, you need that little extra bit of cash that can help the family. Like if you wanted to take a trip somewhere or go on a little vacation, or, you know, it might be something with your car that you might have a little bit of extra money there that can fix that. That's where your cash value will come in. The dividends are overpayment of premium and company expense, lapses, and investment return. That's what a dividend is all made up of. Now, there's a lot of people out there that say, I don't want a dividend. I can tell you this for a fact. Over the last 150 years, insurance companies can't guarantee the word dividend, but I'm gonna tell you, what the dividend, they haven't missed one time paying a dividend over the last 150 years. They can't say it's guaranteed, but what they can say, here's our track record. Once a dividend has been declared in a whole life par product, that product can only go up. I have never seen a dividend decrease in the 46 years I've been in the business, okay? And I've been with a multitude of companies as a captive advisor, and then when I got in as a broker, and then when I went in as a financial advisor, a lot of doors open.
So the beneficiary is something that is very, very important. And I think that good, serious consideration should be given before you select your beneficiary, especially if you're going outside of the family. It's also important, say for instance, if it's a husband and wife, and they pick each other for beneficiaries, you need to make sure that your advisor ticks revocable. And by selecting a revocable beneficiary, that means that that beneficiary can be changed at any time. The other type of beneficiary is irrevocable. And if you select irrevocable, actually, the person that the insurance is on don't have control no more. The beneficiary, being irrevocable, has more control of that policy than you do. Because in order for you to do anything with that policy as the insured, you must get consent from the beneficiary. So that's very, very important. The other thing is contingent beneficiary. You should always appoint a contingent beneficiary because you never know what could happen. It could be the husband and wife, one is, or the other is the beneficiary of the other. And the thing is, if they, for instance, were, say, flying a plane together and the plane crashed, both of them are gone. Now, anybody left in that family have a problem because now the proceeds is going to go to the estate. That's a problem. To pick a contingent beneficiary is the way to go. And it helps to protect the family. Also, it is wise to make sure and have a will. We'll get to that a little bit further on. The key thing is that all proceeds from a life insurance policy is tax-free, as mentioned earlier by Fred. So you don't want the monies going to the estate, because if creditors are out there, all of a sudden things could change dramatically. So it's important to make sure that your beneficiaries are in order.
When I pass away, what do my beneficiaries need to finalize the transaction to get the proceeds? Number one, they need the death certificate or the insurance policy or the insurance policy's number. As long as they have that, they're good to go. Any other medical documents the insurance company needs to pay out the proceeds. So let's say, for instance, the doctor, they might say, look, we want information from the doctor on the cause of death, which should be on the death certificate. But a lot of times they like to go a little bit deeper. And that's why those informations, there might be some extenuating documents that they might need at that particular period of time. Okay, this just goes into just give you a brief synopsis of disability income. Why would a person want disability income insurance? The money that's in your pocket, if you became disabled due to an accident or sickness, there could be some major problems there. Because if there's not enough money coming to the household, you start thinking about food, you start thinking about the mortgage and rent, you start thinking about putting clothes on little Susie and little Johnny's back, and so on and so on. All those things, that's what disability insurance basically protects if you were injured due to an accident or sickness. Some companies have a 0 waiting period for accident. Some have 15-day waiting period. Some have a 30-day waiting period for illnesses, and so on, as you can see there, et cetera. Disability covers your monthly income. They normally say 66 2/3. We just put 70% just to round it off. Your most valuable asset is the ability to earn an income. Based on your current age and income, it is based on the occupation that you do. They have different occupational classes, and the high executive occupational classes will get a better rate than a person that is a construction worker. That's disability income. Just giving you a brief summary.
Critical illness is another good type of insurance to have. And critical illness is something that is one of the newer types of coverage. And as a matter of fact, it was a doctor that came up with the brain idea of critical illness. Critical illness would cover you in certain types of diseases or illnesses that you could have. And as a matter of fact, insurance companies have it listed the different types of critical illness that it would cover, such as heart disease, stroke, diabetes, you name it. So it's important to make sure and check with your advisor the different things that you are covered for, because not all things are covered. And from one company to the other, it's important to know so that you can make informed decisions when you are selecting the coverage for your critical illness. Both Fred and I make sure and tell our clients all the time about critical illness. It is just so very, very important. The other thing about critical illness is you can get plans where you can pay the premiums for a certain number of years. And if you don't have to use the critical illness, the insurance company will reimburse all of the premiums that you paid. But this is part and parcel of the contract from the outset, should I say. It helps to pay such things as medical expenses, everyday bills, replace lost income. Critical illness allows money for your health without seeing your financial health decline. It also helps to get rid of a lot of stress, because during these types of times of illness, people really need to have something to fill the gap.
And I just want to throw one more thing on the critical illness side. The person that's the insured is the beneficiary, so it's a living benefit. It's a benefit that if you were the insured of that critical illness, you would be the one that would be collecting these funds, and these funds are collected tax-free. But you get a chunk, like 50,000, 75,000, and it comes to you tax-free. There's a 30-day waiting period. The only thing that has a longer waiting period under critical illness is cancer. Cancer is a 90-day waiting period because they don't know if it's in the body or not. That's the reason why they put that clause in there. Now, the next thing we're going to move on to is what we call estate planning. But before we get into estate planning, I'm going to turn it over to Howie and let Howie talk about whole life insurance and the importance of whole life insurance.
All right. So I'm going to start off by stating that basically there are three types of insurance. There's permanent life insurance, there's universal life insurance, and there's term insurance. These three different types of life insurance have their own unique way in which they work. I'm going to explain how permanent life insurance works. As advisors, when we do complete financial planning for our clients, in many cases, their portfolios will encounter two types of the three types of insurance. And there's a reason for that. In the early years, most people will need a considerable amount of term insurance, because during the early years, most of us are burdened with a heavier debt load, such as a mortgage, new vehicles, furniture, income replacement, and others. Also, in the event of premature death of a spouse, especially when children are involved. So let's take a close look at permanent insurance. It's also known as whole life insurance, how it works, and the benefits of this type of coverage. The full amount of coverage selected never decreases. That's important. And the full amount of coverage is paid out to the beneficiary or beneficiaries upon the death of the insured person. The premiums never increase during the life insurance policy years. The client has the privilege of attaching a term rider to the plan. The client may also attach a term rider to their permanent plan. I just want to take a moment. For instance, a person could have a $100,000 permanent plan or term plan for that matter. And they might want to add their wife on as a term rider because they're trying to keep the premiums so that they're more easy to deal with in their early years. They can also add additional term insurance for themselves to increase their insurance to take care of things within the family or other debts. The client may also attach a child term rider, which I touched on a little bit earlier, which would cover all the children from ages 18 to 25. And as I mentioned, if they pursue secondary education, this rider allows all children to purchase up to 10 times the amount of coverage in view of having this rider prior to the expiration of the rider without having to provide proof of insurability. The client can also add an accidental death coverage rider. The client can add the waiver of premium benefit, which will pay the client's premiums in event of sickness or injury. Permanent life insurance contracts produce dividends, which the client can decide how they want to use their dividends. Although dividends are not guaranteed, insurance companies have paid dividends faithfully for over the past 150 years. There are several dividend options that the client can select on how the dividends will be used, but the most popular selection is paid up additions. I just want to say paid up additions is the most popular because with paid up additions, actually the client is buying additional life insurance, permanent life insurance. And as that life insurance continues to grow each year with the dividends coming in, the client would also get cash value growing on that portion of insurances as well, which just helps to build a pot. Permanent life insurance policies also produce cash value, which is part of the policy, and the client has the privilege of borrowing these funds, which is rather unique, from their policy at preferred interest rates. If for some reason the client decides to cancel their life insurance contract and there is cash value that has accumulated, the client would receive that amount upon cancellation. The cash value can also serve as an automatic premium loan against the policy if for some reason the client missed a premium payment. This process would assist in keeping the client's protection in place. Life insurance is a tax-free benefit. And when the beneficiary is a person or persons other than the insured estate, the proceeds are also credit approved. Personal life insurance can also bypass probate. In later years, after having a policy that has been enforced for many years, the client has the option of taking a paid-up policy. Otherwise, the insurance company would advise them of how many years the reserves of the policy would keep the insurance protection in place without having to pay any premiums. If, for instance, that period was determined to be 20 years, and in the 21st year, the insured was still living, the insured would be required to resume premiums to keep their protection in force. The insured could also request a reduced coverage paid up insurance, which would expand the years of not having to pay any additional premiums. I have been sharing this information with you on how a participating life insurance works. However, there is also a non-participating permanent life insurance contract. My colleague Fred alluded to this earlier. The main difference with a non-participating life insurance is the fact that there are no dividends. And because of that, the non-participating plan has a tendency that the premiums are a little bit less and coverage remains the same. At the outset, the company determines how much cash value you would receive, because with the non-participating plan, you would still receive cash value. But with the participating plan, you can receive more dividends and more cash value. Okay, great.
Now, estate planning. Why is estate planning so? And I'm going to get into the particulars of estate planning and why it's. When you're looking at an estate, number one you want to build is you want to build what we call a team, estate planning team. That's a lawyer that would handle any legalities that would exist in the estate. The accountant and lawyer could handle the tax portion of the estate, all depends on if it's a tax lawyer at that time. You have a life insurance advisor where he would basically handle the proceeds of the life insurance. If you ask me, in this scenario, the life insurance person is probably the most important person in the estate. Why? He's the person with the cash. He's got the cash. So when a person passes away, those proceeds, when he walks to that door and hand that family that check for $50,000, $200,000, $1 million, that's unique. That's very unique. The trust officer is basically there to set things in place for family members that they feel they're not competent enough to basically make sound financial decisions. The trust officer would be there to help them make financial decisions. The investment advisor, he would have his role in there as far as making decisions on what is my investment profile? What is this client's investment profile as they are investing? And as that investment advisor makes sound decisions of helping that particular client that has an estate, plays his role. In the financial advisor, his role is basically to put together the whole piece and present that through either a financial need analysis or a financial plan, whatever fits that person at that particular period of time. These are some of the financial tools you need to protect your estate. One is a will. If you die without a will, you're dying intestate. If you die with a will, that means that you're dying testate. Power of attorney. This is the person that can make financial decisions if you're incapable of making the financial decisions in your overall estate, as far as bank accounts, as far as making, and they call that an enduring power of attorney at that particular period of time. And then the living will bounces back and forth with the power of attorney. And then you look at your executor and executrix. This is if the person passes away. You have your executor and executrix that will actually really work on behalf of your overall estate and make sure that your wishes are done from the grave. A trust fund is, like I said, the trust fund will basically be set up so that it will make sure that if monies are going to be placed in a certain area and a certain amount of money is going to be given to that person over a period of time, they play a very, very good role. Life insurance is another tool. Here's a big one: guardianship papers for the children. Al, you want to talk about that? You love talking about that.
I do. Yes, it's so very important to make sure and pick guardians for your children. The key thing is our children are special, and you want to pick somebody that you know that would guide your children in the right direction, because you want to see that your wishes will be carried out the same as if you were here. Guardianship needs to be given serious thought. The other thing is about children is that we need to make sure and set up trust funds for our children. In some instances, we might think that we have picked the right person to be the guardianship of our children, but maybe we have made a mistake, and that person is not using the monies that you have left with them for the children as you would like. But if you have set up some trust funds, for your children, you can make sure that those children are the ones that would get that money. And the other key thing is, when you're setting up trust funds for your children, for instance, you might set it up that they would get $2,000 at the age of, say, 18. And then you might set it up so that they would get $4,008 at the age of 20. And I mention this because sometimes children, they don't know how to use money. And once they get this money and their friends know that they have this money, they'll help them to spend it. But once the money is gone, in most cases, the friends are gone. So it gives them a 2-year period to get their heads straight. And that is so very important for them. And you can set it up for different years up to whatever age you so desire. But it's crucially important to do that.
Estate planning and the role of life insurance playing their role in estate. Life insurance plays a vital role in the estate planning, including preserving the value of your estate, providing financially for dependents or surviving spouse, or ensuring money is available to pay the taxes, fees, and other outstanding debts upon death. Any estate, large or small, will require money to pay taxes, legal fees, administrative expenses, outstanding debts. Even provide estate liquidity is also very important. And what I'm talking about is like capital gains taxes, dividend taxes, or even interest income. So interest income, dividend income, and capital gains income. Upon your demise of leaving this world, there's certain things that has to be taken care of to make sure that your estate is 100% taken care of. One of the greatest benefits of life insurance is that it provides tax-free money to your beneficiary. That says Fred and Howie. And the reason why it does is because when a person dies, most people like to take the lump sum of cash when a person dies. But there's something that's called an annuity. An annuity can make sure that, hey, if something happens to me at death, that there will be ongoing income for my family members, but they don't take the full chunk and just blow it. So you can set it up in the policy to have what we call a term certain annuity, 20-year, 10-year annuity, that you can basically set up in that policy that would be very beneficial to the loved ones that you leave that money behind to. Life insurance can not only be used to protect surviving dependents, but also to create and preserve funds to ensure the fair, equitable distribution of your estate. Providing for your dependents, life insurance can replace earnings, pay debts, providing for the education and daily living expenses of your family and dependents. If you have a special needs child who requires care for a lifetime, life insurance can provide the necessary funds in the case of a divorce or separation. The courts can make a family member, or if you're in a divorce situation, the courts can say that you can buy life insurance on your spouse, you can buy life insurance, and those spouses would be the beneficiary of those particular policies. Providing for your dependents. Normally, life insurance proceeds are paid in one tax-free lump sum to your beneficiary. However, insurance contracts can also provide a number of settlement options. That's what we call it, such as purchasing an annuity with the proceeds. This would allow for payments of the death benefit and installments over time. This may be something to consider if there are concerns with the money management skills of your beneficiary. Very, very important. Would you say that, Howie?
I would agree.
Okay. Life insurance proceeds. Why do they say that life insurance is one of the very good vehicles when it deals with preserving a person's estate? It can be used to pay debts. Why does it pay debts? When people die with credit card expenses, line of credit expenses, even car expenses. And if their home is not insured for the mortgage, that could be an expense. Taxes, it could be capital gains taxes, it could be dividend or interest taxes, and other estate costs, so that the estate assets such as a registered retirement savings plan, okay, those things have to be deemed disposition at that time and disposed of. And once they're disposed of, it enters into that person's income. And then once they disperse those funds back out, those funds are provided as an RRSP or RIF income or not erode to pay these expenses, like capital gains taxes, tax associated with registered plans and probate fees can all be covered by life insurance. And here's a unique factor. What Howie did say is that life insurance will what? It doesn't go through your estate. So it doesn't become the large sum of your estate at that particular period of time. What life insurance will do, it passes outside of the estate. So within 7 to 20 days, they would have that money in their hands to take care of any necessary expenses that would have to be taken care of at that time. Preserving your estate. Well, Canada Revenue Service, or CRA, considers a deceased taxpayer to have disposed of all depreciable and non-depreciable capital property for fair market value immediately before death. Example of depreciable capital property includes equipment, buildings, business vehicles. Non-depreciable includes shares of a corporation, partnership interests, mutual funds, seg funds, and units, and recreational property and land. Life insurance can also provide the necessary funds to pay capital gains, taxes, and any other taxes that would exist at that time. And it's particularly important if beneficiaries wish to retain property, or if a market condition will not provide the estate with an amount equal to the fair market value of that property. Give you an example when we say fair market value. You might have bought the property at 100,000. And let's say that the property grew to 250,000. That's the fair market value that it had went up to 250,000. So now, if you bought the property for 100,000, there's 150,000 of what? Capital gains in that particular situation. And it could be quite extenuating at that particular period of time if there's not cash available to provide it. That's where life insurance will step in and say, hey, you have some life insurance there, tax-free benefits that can provide the necessary evil of paying off those expenses so that your family doesn't have the worries and headaches that some families that don't do this type of planning will have. The best advice I can give is to consult either Fred Perry or Howard Williams that are qualified insurance professionals, because there can be many tax scenarios. And we always recommend that you go to your tax accountant, because we're not tax specialists. They are tax specialists. That's what they live their life. That's what they went and got their degrees and everything for. There's no one size fits all solutions. I know that a lot of people say sometimes, buy term and invest the difference, but it's a lot of factors that go into that. And yes, we recommend highly term, maybe in the beginning years when a person's starting out, but then as the years go on, the person probably wants to look at possibly getting something more levelized where the premiums never go up and they're locked in at that age that the person decided to lock it in. Life insurance is also often used to replenish an estate, like debts. It may erode your estate. What would otherwise be available to the beneficiary? By having life insurance to pay the debts, your estate may remain intact for your heirs. Canada Revenue Service considered that upon your death, a taxpayer disposes of their RSPs, RIF, for proceeds equal to their fair market value, similar to property. This means the funds from these plans are fully taxable in the year of death. As the capital gain liability resulting from bringing registered funds into the income of a surviving partner or spouse.
Okay, estate planning, probate fees and others cost. Probate is a legal process that validates your will and confirms the appointment of your executors. Probate fees are based on the value of your estate and vary from province to province. Life insurance can provide the necessary funding for your probate costs, burial and funeral expenses, estate administration, cost, i.e. executor fees, valuation and appraisal fees, and any other legal fees or accounting fees that may have incurred. Life insurance proceeds are paid directly to the beneficiary and do not form part of the assets of your estate for tax purposes. Life insurance proceeds are beneficial in covering estate processing. Life insurance can be an efficient way to create an estate or pass on wealth to the next generation, as more funds can be provided to heirs tax-free. Life insurance can provide equal distribution to beneficiaries. An example would be an estate that includes shares of a business to be distributed among family members who are active in the business.
And Howie, can you just go back one slide again? Howie, can you just elaborate a little bit more on passing down money through life insurance to the intergenerational wealth that they can build with these modern life insurance policies that exist today? Because we don't talk enough about intergenerational wealth.
Yeah.
Okay, and in our communities, we should be talking about intergenerational wealth because of what it can do for a family.
Fred raises a very valid point, and unfortunately in a lot of our communities, maybe all of them, this is something that we fail at miserably, is passing on this wealth to the future generations. We seem to be concerned about just taking care of the immediate things. I'm not saying that we shouldn't be, but we should also be setting ourselves up, if possible, to pass on intergenerational wealth to our families members. And it's so crucially important. And we're behind the 8 ball on this. It's giving away something, like you're leaving something behind. You want to see that your children will not have to struggle as much as you did. And this is something that we really need to try and do more in the future. I would like to say that it's not always easy to do this, but we need to try our best to pick it up a notch, if I can say that.
Leaving money to charities might be another avenue. You can use a life insurance policy to make charitable donations. The proceeds go to the organization you name as beneficiary. If the charity is registered with CRA, the premiums can be tax deductible. This is another method of reducing the tax burden of your overall estate. Your beneficiaries affect whether or not life insurance proceeds are protected from claims of creditors. And what we mean by claims of creditors, it might be Visa that wants to come after you. It might be MasterCard that wants to come after you. It might be even the banks that want to come after you. But you can't defraud CRA in this particular area. If you're trying to do that by putting in creditor protection, they can override that. They have the powers to override that. Provincial insurance law provides that where a spouse or child or grandchild or parent is a beneficiary, the insurance proceeds are exempt from seizure by creditors. The law varies. The current law today varies from province to province. So be sure to ask your advisor about your specific situation. Very important. Life insurance can serve many purposes and meet needs throughout an employee's medical profession, any other occupation throughout their lifetime, even as those needs change through the years. One of the things that I like to say, finally, even if you already have life insurance protection in place, depending on whether you had the opportunity to review that insurance or your estate insurance needs, it may require an update at this present time. We have to be, as a community, we have to get more serious with life insurance, because when a person dies, That's the most important thing in everybody's household. Do they have life insurance? This thing where families have to come together because they didn't have any life insurance and somebody had to put in 1,000, another person had to put in another 1,000, it gets ridiculous. If we do the proper planning with an advisor, we're in a much better way of serving the needs of our loved ones. Now it's time for questions and answer session that you can throw at me and Howie. We'd be more than happy to answer those questions. And the floor is now open for question and answers.
Through the presentation, you guys mentioned that you guys have the options to borrow against your life insurance or use that as that cash value you're discussing. Could you discuss a little bit around how that might impact, like if I were to be like, hey, I need cash value, I need to take something out, what is that process like? How does that impact the policy?
Well, I'll answer that for you. It's very simple, actually. You would call the insurance company yourself if you wanted to, or you can call your advisor and we would handle it for you. The insurance company is very lenient in doing this. And as a matter of fact, you could have the proceeds within a week. And as I mentioned earlier, you can usually, you can get it at a preferred interest rate. You don't have to give any particular reason why you need it. It's there, and that's one of the purposes that you can use it for. So it's no problem whatsoever. You would just ask for it, and if it's there, they will provide it to you.
Can I add on a little bit more to that? The other thing, Howie, too, that's really great about having that type of life insurance in play and being able to use the loan factors is because there's no credit check. You can have the worst credit in the world and you can still, if you have a whole life policy or a universal life policy, you can get those funds and no questions asked. There's no application, you just sign what we call a loan request, which is very, very unique.
So how would that impact it? So really easy to get that money and get that access to that capital. But would it impact my policy? Would my policy be worth less? Would I have to pay that back? How would that?
Yes, you would have to pay it back to keep the policy intact. But for instance, if a person had this would be naturally a permanent plan. And let's just say that it was $100,000 policy and you took out $10,000 and death took place. What actually would happen there is that they would still pay the death benefit, but they would minus the amount of the loan off of that death benefit and send the remainder to the beneficiary.
Okay, that makes sense. Kim asked, can policies be purchased for kids separately instead of as a rider?
Yes, they can. Kim, they can definitely be, they can have their own separate policy. And one of the things that we recommend that you put on there is guaranteed insurability. The guaranteed insurability clause basically protects the kid's health throughout the policy. And when they get of age, they have the right in that particular policy to purchase or take over that policy at some future point, based on if you allow for that to happen at that particular period of time. Because remember, you're the owner of that policy, they're the insured because you're paying the premiums.
Does adding a rider to your policy affect your premiums?
Yes, it does affect your premiums. Adding a rider is usually a very small fee to put a rider on, but it's worth its money in gold to have riders on your policy. And I recommend that, you know, if you can put the riders on when you take the policies out, do it. It's another way of providing coverage when you can't afford to put those individual policies, riders onto the main policy. But it is important that as soon as you can to, yes, put an individual policy on your children because Fred and I both agree there's so many benefits that you can take advantage of by having those. And the other thing is there's a guaranteed amount of coverage that as a child proceeds at different ages, they're guaranteed to be able to buy different amounts of insurance without having to provide proof of insurability.
I just want to share something with you. When I was in university, I had one of my friends that was in university. His grandmother took a policy out on him when he was 1 year old. When he got to be the ages of 20, 21, 22, this kid had $43,000 of cash. And that was back in the 70s when I was in university. That's amazing for a student to have that kind of money because his grandmother looked after him. She said, if I can't give him something, I can give him a life insurance policy that would have cash build up in it over a period of time. And if he wanted to cancel the policy at that time, he has the right to cancel it. If he doesn't, if he wants to continue the premium payments, he can continue to do that as well.
I would just like to throw something else in there as well.
Yeah.
One of the things that I want to encourage young people to do, and that is to buy life insurance as soon as you can. A lot of young people will say, you know what, I'm not married. Why do I need life insurance? Well, I'm going to tell you, if you're wise, you would buy a good permanent life insurance policy as soon as you can afford it. And you can maintain it. Because when you get older, you're going to be very, very happy that you did. Not only is it going to have a good pool of cash value in it, but all the other benefits that come with a permanent policy. And as a matter of fact, you will find out your colleagues will be buying some term insurance at a later age. And you might find out that your permanent plan premium is actually lower than what they're now paying for the term because you brought it when you were young. And over the long haul, it's my opinion, bar none, that permanent life insurance is the best type of insurance on the market. But it's crucially important, young people, to buy it as soon as you can. You will never, ever regret it. I have some clients that did that when I first got into the industry. And when they see me now, they're smiling. They're smiling because they got a nice pot of money sitting there.
Next, all right. So are you able to purchase term insurance with one company and whole life with another? Is it recommended to have them at the same company?
You can purchase as many policies that you can afford. You can have a term policy with Equitable Life. You can have another one with Canada Life. You can have another one with London Life, whatever you can afford. And it could be many companies. But sometimes it's good just to maybe have it under one roof. It's because then you know that all your transactions that you have done with that particular policy will be under that same company that you totally understand, and it will work in your benefit. But you can have as many policies as you want. You can have term in one company, you can have a whole life policy in another company, you can have a universal life policy in another company. It's totally what you can afford.
It was about whole life insurance. I have a question about participating and non-participating.
Okay.
Benefits and drawbacks. Can I get a little bit more information about those topics?
Yes, the difference between them is pretty basic, really. The non-participating insurance doesn't have any dividends whatsoever. It's a policy that it's still a permanent policy. The premium never changes. And the cash value was set out from the outset that the company is going to pay at the given years. It's still good protection. And if somebody would like to have permanent insurance that maybe aren't interested in having all the bells and whistles that the whole life permanent type would provide, they might say, I just want permanent coverage. I want it as cheap as I can get it, we would look at probably the non-participating policy that would still give them that coverage, gives them a lower premium, but they're still good to go. And they still have the benefits of borrowing on the cash value, just like participating policy. So hopefully I answered your question.
Yes, thank you.
And could I just impact it just a little bit more on the par whole life situation, which makes a par whole life a very unique product, is that once you get involved in that par whole life, you have two choices. You can either go 20 years or you can go to age 100, paying the premiums. It's totally up to you what you feel comfortable, what you can afford at that particular period of time that would be beneficial to your pocketbook. Then it all depends on how they lay out the dividends, is explaining the dividends. You got dividends with has accumulation, you got dividends that can reduce the premium costs, you got dividends which we call paid up additions that buy additional insurance and give you additional dividends in that policy, which is unique. Okay, so like when a person dies and they've taken out loans, a lot of times if they have paid up additions in the policy, the main amount, the basic amount that you started out with, it won't hurt it. Okay, so let's say, for instance, you start out with 100,000, but your policy grew to 150,000. So you got that new 50,000 that sits there. And then when you look at that particular policy, you say, okay, now in that policy, I've taken out a $25,000 loan. And then there's a $25,000 loan with the interest on that particular policy. So you say to yourself, if I die today or tomorrow, yes, I got to pay back the 25,000 plus the interest. You still have your base amount because you had 150,000 in here. So there your family would end up with 125,000 or less, but they still have their base, which was 100,000, which makes it unique.
There's one thing I wanted to mention in addition, Fred, and that's, I think we missed that you can buy, for instance, a term insurance policy. Let's say it's somebody that's struggling, but they can afford, let's say, a couple $100,000 worth of term. One thing that you need to know is that as soon as you can convert a portion of that term to permanent insurance, okay? And that's good to know, because a lot of people don't know and they think they got to stick with just that type of plan, but they can convert a portion or the whole thing for that matter to a permanent type of plan.
Last thing. There's something that we call simplified issue. We'll get people that will come to us and say, I had a heart attack, I had a stroke, I had cancer. Can you insure me? There are policies out there that can insure people that have some of the worst health conditions. And we know the companies that do that because of over the years, we have basically seen companies that will insure a person that had diabetes and the diabetes maybe amputated a leg or amputated a hand or a finger. We have that insurance that's in place that will take care of a person that had a heart attack. And they say, well, can you cover us? Yes, you can. There's major insurance companies out there that what we call simplified issue that will basically take care of the needs, and they have term and they have permanent insurance, which is unique.
There's another question as well. What's the difference between whole life insurance and universal life insurance?
Okay. Whole life insurance is the factors where we talk about that you have a level premium, that premium will never bump up. When you look at universal life, you have to do with that particular advisor at that time, you have to do an investment profile. There are three different types of premiums that they have. They have what they call a minimum premium, they have a target premium, and then they have what they call, you can max out in that policy. But remember, if you max out in that policy, you got to watch the tax consequences. And insurance companies are very smart in that particular area because they can take the max amount. If it's over that amount, they can flow that into what we call a side account. Okay. But where people get in trouble with universal life, they take the minimum premium in a universal life And they don't understand that it's term in that policy. And sometimes the term goes up every year, the cost. So 20 years down the road, they say, man, why is this policy costing me so much? The reason why it's costing you so much is because you didn't realize the element of term insurance in that particular policy. Now, if you had to max that policy out, so let's say if there was $100 premium for minimum, then let's say there was a $250 premium for your target, and your max was $450, you're probably better off paying the $450 because you won't feel the elements of that insurance bumping up every year, your cost going up. So if your cost is going up for insurance, that means there's less money going into the investment accounts.
So, and correct me if I'm wrong, I'm just trying to see if I understand.
Okay.
this. So what you're saying is that a universal life insurance has term life insurance plus an investment account,
That's correct.
and then the whole life is just the full length of your life,
That's right.
only insurance, no investment.
That's right.
We do believe that this is valuable information, which is why we wanted to bring experts to the table to be able to share that information with our community. And we will continue to do so. So if you do find this beneficial and helpful, keep an eye out. We're gonna have additional sessions. We're gonna have more information to share with the community. I do want to open it up one last time, if there are any last and final questions. Okay, seeing none, I'm going to turn it over to our speakers to give the final word. And as we mentioned earlier, the presentation will be shared with all the participants as well as our mailing list. And this presentation has been recorded, so you will also get this presentation as well in full to be able to review and answer any questions or go back and forth and review that information that was given. And of course, in that presentation, our two speakers' contact information will be shared as well. So if you had any direct questions or wanted to follow up or maybe have some discussions about your own personal situation, you do have the opportunity to do so as well. So again, I'm not the expert. I will stop speaking and turn it over to our two experts to close the evening.
I'm gonna go first, Fred.
Okay.
I just wanted to say thank you for the opportunity. The key thing that I want to mention is when you decide that insurance is important in your life, don't procrastinate. Move forward with it. And it's crucially important that you continue to pay your premiums and keep it up. Don't just buy a little bit of insurance and say, this is enough. Have your advisor do proper planning with you and buy it. Make sure you take care of your families, because in a lot of our communities, this is not done. A lot of people say, well, you only need enough to bury you. No, you need a lot more than that. There's so many important issues and things that must be covered, as we already have mentioned. So if you're a loving person, love your family enough to do the right thing. Thank you.
I want to thank everybody for listening in tonight. This is an opportunity of a lifetime. You have two experts that's coming to you with a multitude of information that could be very, very valuable to you if you listen to what we're trying to share with you. It's very important. Just always remember, always build a solid financial foundation. And we believe from our standpoint that life insurance plays a very strong role in anybody's financial plan. I know that financial advisors normally recommend term and move on, but there are some key issues when you want to sit down and talk about par whole life and what the benefits that it can bring to your family. One of the things is that I feel that par whole life works just like a mortgage, okay? You can also work whole life as the banking process. And they call that infinite banking, modern money solutions, bank on yourself. And I'm a bank on yourself authorized advisor and an infinite banking concept and a private family bank consultant, where I show people things that they can do with their particular policies that could be very, very exciting and very, very beneficial. But use Howie and I. We're here to help you extend on our knowledge. We can do virtual sessions, or we can do a one-on-one session with you. It's totally up to where you want to go. We're more than happy to help. And again, I say to our communities abroad, thank you very much. And we're going to close now and have a great evening. And thanks for, like I said, dialing in this evening.
So I'd just like to say, just on behalf of the Road to Prosperity, thank you for tuning in, and we have a lot more coming. There's some of the topics are going to be what, debt management, retirement planning, investments.
Yep.
So there's a lot more coming from these two. How much? 80 years of experience?
That's true.
Yeah, so we have a lot more coming. So thank you for tuning in, and anything you need, get in touch with these two young men, and they'll meet with you and take care of your needs. Thank you very much.
Thank you.
Thank you, everyone.
Thank you.
Have a wonderful evening.